Welcome to the Real News Network. I'm Gregory Wilpert, joining you from Quito, Ecuador. UK households are spending more than their income at an unprecedented rate. Record-busting levels of privately held debt are also accompanied with stagnant or even falling real wages in the UK. The situation is so bad that members of parliament have started calling for a public inquiry into £200 billion worth of privately held debt in the UK. Perhaps even more disturbing is the argument of our next guest, who says that the only thing keeping the UK out of recession is the growing and unsustainable levels of privately held debt. Joining us today to discuss the growing private debt crisis in the UK is Ed Smythe. Ed is economist and researcher at the financial research organization Positive Money. He worked for 9 years as an asset management and as an equity analyst and macroeconomist. He recently wrote an article for Open Democracy called "The UK is Hooked on Rising Asset Prices. What Happens When the Bubble Bursts?" Thank you for joining us at The Real News, Ed.
Thank you for having me.
So in your article, you say that the British economy is being kept afloat by unsustainable levels of privately held debt. What is the basis of this observation of yours?
So essentially, and in fairness, it's not just debt, it's also capital gains. So the way to think about this is we can look at the sectoral flow of funds in terms of how the UK economy is growing. And at the moment, we can see that the UK household sector is running an unprecedented deficit, more than it was before the last financial crisis, and in fact, more than it's ever done in the 100 years of records that we have. Now, the question is, how are they funding that? And in part, that's coming through debt, but we argue that it's also coming through massive capital gains over the last 3 decades or so as interest rates have come down. So it's the combination both of debt and capital gains that are funneling and funding that deficit.
And some, such as David Graeber, recently also argued, and I think you mentioned in your article, compare the current private debt level to the private debt levels that led to the 2008 global financial crash. So are we in this territory now? And is it likely that the current private debt levels will repeat what happened back in 2008?
Yeah, so I mean, I think it's interesting. We had Mark Carney on record recently in a speech that he made last week, talking about the fact that household debt levels are actually down relative to where they were relative to incomes before the last crisis. But actually, that's focusing on a bigger metric, which includes mortgages. If you just look at consumer and student loan debt, that's actually rising at the fastest rate ever. So it's rising at about £31 billion per annum, whereas before the crisis it was rising at about 25 billion. It's also risen to the highest ever level at about 315 billion. So there's a clear red flag that to the extent that private debt was the cause of the last crisis, it's absolutely waving it today to suggest that this could be a factor in causing the next financial crisis.
I mean, back in 2008, one of the detonating factors was that investors were partly misled about the nature of the debt that they were taking on when they were buying the mortgages and so on. In other words, they were given AAA ratings in the United States when actually they were very questionable loans that had been given out. And when people couldn't pay them off, then all these investors were caught, unawares of the type of loans they had. Is there any chance that something like that would happen? I mean, is there any misleading going on, or or what would trigger, in other words, a possible crisis this time around? Raising of interest rates. What would be, so to speak, the detonating factor if something were to happen?
Yeah, I mean, so strictly speaking, when we talk about consumer and student loan debt, that doesn't include mortgages. So it doesn't necessarily relate to what you talked about in terms of the mortgage provision that occurred prior to the last crisis. But in answer to the question, is there a risk that many of these consumer and student loan debts are created on the backs of people who might simply not have the ability to repay? Absolutely. We are seeing signs, particularly in the PCP lending market for autos, that the availability of credit is at an alarmingly high level. There's a complacency in the market, which typically happens after many years of recovery, where lenders reduce those checks that should be in place. And therefore, once you've done that, you create the conditions by which even a small trigger might start to bring down the whole sort of cascade, if you see what I mean.
Uh-huh. And so, what kind of proposals have you been suggesting to push the UK away from debt-based, consumer-driven economy?
Well, and in reference to the first argument that I made, it's not just consumer and student loan debt that bothers us, and also the mortgage debt market. It's the fact that actually we've also been reliant on a massive expansion of net wealth. And in fact, the UK's net wealth to disposable income ratio is now the highest for any developed economy ever, worse than Japan in 1989. So what we're saying and what Positive Money is advocating is a fundamental shift in monetary policy and the mechanism by which money is being used to sustain economic growth. We want to shift from the policy whereby at the moment we need very low interest rates to boost the price of assets or to enable increased amounts of debt to generate a certain amount of household spending, their deficit, which is currently driving the economy, and instead shift to a much more sustainable mechanism whereby money's created by the central bank using zero interest perpetual bonds, an incredibly constrained amount, which allows governments to then spend that directly into the economy to get the sustainable increase in demand that we need. And in doing so, you could actually turn down some of these other dials of ultra low interest rates and QE. You could have a somewhat reduction in, for example, asset prices, a reduction in the expansion of ever greater amount of credit, and instead you've got a sustainable demand function. So it's the policy of overt monetary financing, or QE for people is what we'd call it. And it seems to be the only mechanism by which we can move from the current status quo to something much better.
You recently spoke also at the Conservative Party conference. What was the gist of your presentation and how was it received there?
I mean, the presentation was called After the Crash. And I suppose our argument was actually, when we look at many sort of metrics, it's very difficult to suggest that the crash ever ended. So we've just experienced the worst decade of real wages since the 1860s, and perhaps a long time more. We've got record low productivity levels, record low investments, record low interest rates, record high asset prices. So what we're saying is, look, the situation as it stands is simply not a normalized scenario, and therefore we have to be thinking about slightly more radical options, both for in terms of the way we hold the central banks accountable, but also think about these other tools of overt monetary financing, because it's the only mechanism this government can achieve its policy objective of achieving an economy that works for everyone, and particularly for the younger generation.
I mean, the proposal to me sounds a bit like you're suggesting that the government should essentially spend more and essentially by steer away from the austerity policies of the past 10 years or so. Is that correct? Is that a fair summary?
It absolutely is, but it's with a sort of a modified agenda behind it as well, because I suppose we are currently working within a paradigm whereby governments, when they spend, are necessarily imposing a sort of intergenerational tax on the next generation to pay that debt back off with interest. What we need, particularly given the intergenerational transfers that we've seen to date, we need a system whereby we can fundamentally deliver demand into the economy on the things we need, like infrastructure, education, and healthcare, but without saddling the next generation with huge interest costs on this debt. What we need is a policy whereby governments feel that they can spend a little bit more on those things without increasing the potential for an interest cost down the line. And that's why overt monetary financing is the only solution to deliver that step change in government spending and shift us back onto a sound fiscal footing.
And how do you think that the Labour Party is on this issue, which also just recently wrapped up their party conference?
Yeah, so I mean, we are having interesting conversations with members of both parties. We think you would imagine that the Labour Party should be more receptive to these arguments. At the moment, they are focused to a large extent on a national investment bank, which delivers some small benefits, but we would argue it's not big enough thinking. If you think about, for example, the problem on the next 50 years, and I think it's important that people do, the OBR predicts that the amount of the government deficit will increase to a primary deficit of 9% in 2065, just as dependency ratios, etc., really kick in. And so what we're saying is we need a fundamental solution that will stand the test of time. It can't be gimmicks. It can't be small tweaks around the edges. We need to be reframing the whole debate about monetary policy and how much governments can spend, and sort of confronting directly some of the arguments, the misplaced arguments that have often been used to counter this type of proposal.
Okay, well, we'll probably come back to you again once we see a little bit clearer as to which way the UK is heading in this issue. But thanks so much, Ed, for having joined us for today.
Thank you very much for having me. I enjoyed it.
I was speaking to Ed Smythe, economist and researcher at the financial research organization Positive Money. Thank you for watching the Real News Network.